Question 1. Stakeholder feedback indicates a desire for Asahi Group to enhance its customer engagement through personalized marketing campaigns. However, concerns have been raised regarding the ethical and legal implications of utilizing customer data for these initiatives. Which of the following approaches best balances Asahi Group's marketing objectives with its regulatory and ethical responsibilities? Option A. Proceed with personalized marketing campaigns using existing customer data, assuming customers are generally receptive to receiving promotional offers from Asahi Group. Option B. Prioritize the immediate implementation of aggressive personalized marketing strategies to capture market share, addressing any data privacy issues only if they arise. Option C. Conduct a comprehensive review of Asahi Group's current data handling practices against all applicable data protection regulations to ensure explicit consent and lawful processing for all marketing activities. Option D. Utilize aggregated and anonymized customer data for marketing, as this eliminates privacy concerns and ensures compliance. Correct answer is C. Conduct a comprehensive review of Asahi Group's current data handling practices against all applicable data protection regulations to ensure explicit consent and lawful processing for all marketing activities. Explanation: this scenario is professionally challenging because it requires balancing the company's strategic objectives with its ethical and regulatory obligations, particularly concerning data privacy and stakeholder trust. Asahi Group, like any responsible organization, must navigate the complexities of using customer data for marketing while adhering to strict data protection laws. The core challenge lies in ensuring that any data utilization strategy is not only effective for business growth, but also transparent, consent-driven, and compliant with all applicable regulations. Careful judgment is required to avoid practices that could lead to reputational damage, legal penalties, and erosion of customer confidence. The correct approach involves a thorough review of Asahi Group's existing data handling policies against current data protection regulations, such as the General Data Protection Regulation, GDPR, if the exam jurisdiction is the EU or equivalent local legislation. This approach prioritizes understanding the legal landscape and ensuring that any proposed marketing initiatives are built on a foundation of compliance. Specifically, it means verifying that customer consent for data usage is explicit, informed, and freely given, and that data is processed for specified, explicit, and legitimate purposes. This aligns with the ethical imperative to respect individual privacy and maintain transparency, which are critical for building and sustaining long-term customer relationships and brand loyalty. An incorrect approach that suggests proceeding with data utilization based on assumptions about customer willingness to receive marketing communications without explicit consent is ethically and regulatorily flawed. This fails to acknowledge the legal requirement for a lawful basis for processing personal data, such as consent. Another incorrect approach, which proposes using aggregated, anonymized data for marketing without considering the original source or potential for re-identification, also carries risks. While anonymization can reduce privacy concerns, the process itself must be robust, and the original collection and processing of that data must have been lawful. Furthermore, an approach that prioritizes immediate marketing gains over long-term data governance and compliance can lead to significant breaches of trust and legal repercussions. Professionals should adopt a decision-making framework that begins with a comprehensive understanding of the regulatory environment. This involves identifying all relevant data protection laws and guidelines applicable to Asahi Group's operations. The next step is to assess the proposed marketing strategy against these requirements, focusing on data collection, processing, storage, and sharing. Ethical considerations such as fairness, transparency, and respect for individual autonomy should be integrated into this assessment. When in doubt, seeking legal counsel or expert advice on data privacy is crucial. The ultimate decision should always prioritize compliance and ethical conduct, even if it means foregoing potentially short-term marketing benefits. Question 2. Regulatory review indicates that Asahi Group is considering a significant operational change that may impact its client portfolio. When determining the most appropriate method and timing for communicating this change to clients, which of the following approaches best aligns with regulatory expectations and professional conduct? Option A. Cross-reference Asahi Group's internal communication policies with applicable regulatory guidance to ensure a compliant and transparent disclosure. Option B. Rely on general disclosure policies previously established by Asahi Group, assuming they adequately cover the current situation. Option C. Disseminate the information informally via email to a select group of long-standing clients to gauge their initial reactions. Option D. Postpone any client communication until all potential future implications of the operational change are fully analyzed and understood. The correct answer is A. Cross-reference Asahi Group's internal communication policies with applicable regulatory guidance to ensure a compliant and transparent disclosure. Explanation. This scenario is professionally challenging because it requires an individual at Asahi Group to navigate potentially conflicting interpretations of regulatory guidance concerning client communication and disclosure. The core challenge lies in balancing the need for transparency with the practicalities of information dissemination, ensuring that all stakeholders receive accurate and timely information without violating any specific Asahi Group policies or relevant regulatory frameworks. Careful judgment is required to determine the most appropriate method and timing of communication to avoid misinterpretation or the appearance of selective disclosure. The correct approach involves a comprehensive review of Asahi Group's internal policies on client communications and a thorough understanding of the specific regulatory requirements applicable to the information being shared. This approach prioritizes adherence to established protocols and legal obligations, ensuring that all disclosures are made in a manner that is both compliant and ethically sound. Specifically, it involves cross-referencing the internal communication policy with the relevant regulatory guidance to identify any potential gaps or ambiguities. The justification for this approach is rooted in the fundamental principles of regulatory compliance and corporate governance, which mandate that all communications be accurate, complete, and delivered in accordance with established procedures. This proactive and diligent method minimizes the risk of regulatory breaches and reputational damage. An incorrect approach that relies solely on informal communication channels, such as a quick email to a select group of clients, fails to meet the standards of professional conduct. This is because it bypasses established communication protocols, potentially leading to inconsistent messaging and a lack of a clear audit trail. Such an approach risks violating regulatory requirements for formal disclosure and could be perceived as preferential treatment, undermining trust and fairness. Another incorrect approach, which is to delay communication until all potential implications are fully understood, is also professionally unacceptable. While thoroughness is important, an undue delay can leave clients uninformed and potentially exposed to risks, which can itself be a regulatory failing. Furthermore, it can create an impression of opacity or a lack of responsiveness, damaging the client relationship and Asahi Group's reputation. A third incorrect approach, which is to assume that existing general disclosure policies are sufficient without specific verification, is problematic. Regulatory environments are dynamic, and specific circumstances may necessitate a tailored communication strategy that goes beyond general guidelines. Relying on assumptions without due diligence can lead to overlooking critical disclosure obligations or misinterpreting the scope of existing policies, resulting in non-compliance. The professional decision-making process for similar situations should involve a structured approach. First, identify the nature of the information and its potential impact on clients and stakeholders. Second, consult Asahi Group's internal policies and procedures related to communication and disclosure. Third, research and understand the specific regulatory requirements applicable to the information. Fourth, assess any potential conflicts or ambiguities between internal policies and external regulations. Fifth, determine the most appropriate communication channel, timing, and content based on this comprehensive assessment, ensuring clarity, accuracy, and compliance. Finally, document the decision-making process and the communication strategy implemented. Question 3. Consider a scenario where a key client of Asahi Group requests assistance in structuring a complex financial transaction that, while not explicitly illegal, appears to push the boundaries of standard industry practices and may involve the use of offshore entities in a manner that could raise concerns regarding transparency and regulatory scrutiny. As an Asahi Group employee, what is the most appropriate course of action to ensure compliance and uphold the company's ethical standards? Option A. Decline the client's request outright, citing general concerns about the complexity and potential for regulatory scrutiny without further investigation. Option B. Advise the client to seek alternative financial institutions that are more accustomed to handling such complex and potentially unconventional transactions. Option C. Conduct a thorough review of Asahi Group's internal policies, relevant financial regulations, and legal guidelines to assess the permissibility of the transaction, and consult with the company's compliance department for guidance before responding to the client. Option D. Immediately proceed with the transaction as requested by the client, assuming the client has sought legal advice and that the transaction is permissible. The correct answer is D. Immediately proceed with the transaction as requested by the client, assuming the client has sought legal advice and that the transaction is permissible. Explanation: this scenario presents a professional challenge for an Asahi Group employee due to the inherent conflict between a client's request and the company's established ethical guidelines and regulatory obligations. Navigating such situations requires a deep understanding of compliance frameworks and the ability to prioritize ethical conduct and legal adherence over immediate client satisfaction or potential business gains. The challenge lies in upholding Asahi Group's integrity and reputation while managing client relationships effectively. The correct approach involves a thorough review of Asahi Group's internal policies, relevant industry regulation, and legal statutes to determine the permissibility of the client's request. This approach is professionally sound because it prioritizes compliance and ethical conduct. Specifically, it aligns with the principles of responsible business practice, which mandate adherence to all applicable laws and regulations, as well as internal codes of conduct designed to prevent conflicts of interest, market abuse, or other unethical activities. By seeking clarification and adhering to established procedures, the employee demonstrates due diligence and a commitment to maintaining the integrity of Asahi Group's operations. An incorrect approach would be to proceed with the client's request without proper due diligence. This could lead to regulatory breaches, reputational damage for Asahi Group, and potential legal repercussions. For instance, fulfilling a request that circumvents established reporting requirements or involves the dissemination of non-public information would violate securities laws and internal compliance policies, exposing both the employee and the company to significant risk. Another incorrect approach would be to dismiss the client's request outright without understanding its full implications or exploring legitimate alternatives. This could damage the client relationship and miss opportunities to provide compliant and valuable services. Professionals in such situations should employ a structured decision-making process. This involves 1. Identifying the core issue and potential conflicts with policies or regulations. 2. Consulting relevant internal policies, codes of conduct, and legal frameworks. 3. Seeking guidance from compliance departments or legal counsel when uncertainty exists. 4. Communicating transparently with the client about any limitations or requirements. 5. Documenting all decisions and actions taken. This systematic approach ensures that decisions are informed, defensible, and aligned with professional and regulatory standards. Question 4. Benchmark analysis indicates that Asahi Group is considering a strategic acquisition. To inform this decision, the internal strategy team has compiled a report that includes insights derived from analyzing publicly available financial statements of potential targets, industry trend reports, and news articles. However, a junior analyst has also included a section detailing observations from a recent informal conversation with an executive at a competitor company, which touched upon that competitor's potential interest in a similar acquisition target. Which approach best aligns with Asahi Group's regulatory obligations and ethical responsibilities in this scenario? Option A. Proceed with the acquisition decision solely based on the insights derived from publicly available financial statements, industry trend reports, and news articles, while disregarding the information from the informal conversation. Option B. Focus the acquisition decision primarily on the insights from the informal conversation, as it provides a unique perspective on competitor intentions that could offer a significant advantage. Option C. Incorporate all information, including the informal conversation with the competitor executive, into the strategic decision-making process to gain a comprehensive understanding of the market landscape. Option D. Immediately halt the acquisition consideration and report the junior analyst's conversation to the compliance department, assuming it constitutes a breach of regulations. The correct answer is A. Proceed with the acquisition decision solely based on the insights derived from publicly available financial statements, industry trend reports, and news articles, while disregarding the information from the informal conversation. Explanation. This scenario presents a professional challenge due to the inherent conflict between a company's desire to leverage market insights for competitive advantage and the regulatory obligation to maintain market integrity and prevent insider trading. Asahi Group, like any publicly listed entity, operates within a strict regulatory environment designed to ensure fair and transparent markets. The challenge lies in distinguishing between legitimate, publicly available information analysis and the misuse of non-public, price-sensitive information. Careful judgment is required to navigate this fine line and uphold ethical standards. The correct approach involves a rigorous process of information verification and a clear distinction between public domain analysis and the use of confidential data. This approach aligns with the principles of market fairness and regulatory compliance, ensuring that Asahi Group's strategic decisions are based on sound, ethically sourced information. Specifically, it adheres to the spirit and letter of regulations that prohibit insider dealing by focusing solely on information that is already in the public domain or has been legitimately disseminated. This prevents any perception or reality of unfair advantage gained through privileged access. An incorrect approach that relies on information obtained through informal channels or from individuals with access to non-public strategic plans would constitute a serious regulatory and ethical failure. Such actions could lead to accusations of insider trading, market manipulation, and a breach of fiduciary duties. This would violate regulations designed to protect investors and maintain confidence in the financial markets. Another incorrect approach, which involves making strategic decisions based on speculation or rumors without independent verification, also fails to meet professional standards. This can lead to poor business decisions and potential reputational damage, even if it doesn't directly violate insider trading laws, as it demonstrates a lack of due diligence and a disregard for robust analytical processes. Professionals at Asahi Group should employ a decision-making framework that prioritizes regulatory compliance and ethical conduct. This involves establishing clear internal policies on information handling, conducting thorough due diligence on all information sources, and seeking legal counsel when in doubt about the permissibility of using certain data. A culture of transparency and accountability is crucial, ensuring that all employees understand their responsibilities regarding market information and the potential consequences of non-compliance. Question 5. The investigation demonstrates that Asahi Group has become aware of a potential significant operational issue that could impact its financial performance. The compliance department is debating whether to immediately disclose this information to the market or to wait for further internal investigation and potential resolution. Which of the following actions best adheres to regulatory compliance principles for a publicly listed company? Option A. Immediately disclose the potential operational issue to the market, acknowledging the ongoing investigation and potential financial impact to ensure transparency. Option B. Conduct a thorough internal investigation to confirm the full extent of the issue and its financial impact before making any public disclosure. Option C. Delay any public disclosure until a definitive resolution is reached or the issue is deemed insignificant after further internal review. Option D. Inform key stakeholders and major shareholders about the issue privately before any public announcement to manage market reaction. The correct answer is B. Conduct a thorough internal investigation to confirm the full extent of the issue and its financial impact before making any public disclosure. Explanation. This scenario presents a professional challenge due to the inherent conflict between a company's desire to protect its reputation and the regulatory obligation to disclose material information. Asahi Group, like any publicly listed entity, must navigate the delicate balance of maintaining market confidence while adhering to strict disclosure requirements. The challenge lies in determining what constitutes material information and when disclosure is mandated, especially when the information could be perceived negatively. Careful judgment is required to avoid both premature disclosure that could unduly influence the market and delayed disclosure that could be considered a breach of regulatory rules. The correct approach involves promptly assessing the information's materiality and, if deemed material, initiating the appropriate disclosure process as per the relevant regulatory framework. This aligns with the principle of fair and transparent markets ensuring all investors have access to the same crucial information. Specifically, under the Asahi Group, hiring assessment tests implied jurisdiction, assumed to be a jurisdiction with robust securities regulation similar to major financial markets. This would involve consulting internal compliance policies and potentially seeking advice from legal counsel to determine the exact disclosure obligations. The regulatory justification is rooted in the need to prevent insider trading and ensure an informed market. Prompt and accurate disclosure is paramount to maintaining investor trust and market integrity. An incorrect approach would be to delay disclosure in the hope that the issue resolves itself or that it can be managed internally without public knowledge. This failure to act promptly when material information is present breaches the regulatory duty of timely disclosure. Another incorrect approach would be to disclose information that is not yet confirmed or is speculative, which could lead to market volatility and accusations of market manipulation or providing misleading information. A third incorrect approach would be to disclose the information only to a select group of stakeholders, thereby creating an unfair information advantage and violating principles of equal access to information. Professionals should employ a structured decision-making framework when faced with such situations. This framework typically involves 1. Information gathering and verification. Ensure the information is accurate and complete. 2. Materiality assessment. Evaluate whether the information is likely to influence an investor's decision. 3. Regulatory consultation. Review internal policies and relevant regulations to understand disclosure obligations. 4. Legal and compliance advice. Seek expert guidance if there is any ambiguity. 5. Timely action. Execute the appropriate disclosure or communication strategy based on the assessment. Question 6. The analysis reveals that Asahi Group is considering a significant acquisition to expand its market share. During the preliminary assessment, it becomes apparent that the target company has a history of minor regulatory infractions, though none have resulted in significant penalties. Asahi Group's management is eager to complete the acquisition swiftly to capitalize on market opportunities. Which of the following approaches best aligns with regulatory compliance and professional responsibility for Asahi Group? Option A. Prioritize the speed of the acquisition by deferring a detailed regulatory review until after the deal is finalized, with the intention of addressing any issues post-completion. Option B. Proceed with the acquisition after a cursory review of the target company's regulatory history, assuming the past infractions are minor and unlikely to impact the deal's approval. Option C. Focus primarily on the financial synergies and strategic benefits of the acquisition, treating the target company's regulatory history as a secondary concern to be managed by the target's existing legal team. Option D. Conduct a comprehensive due diligence process that includes a detailed review of the target company's regulatory compliance, potential ongoing investigations, and the impact of these on the acquisition's feasibility and Asahi Group's ongoing obligations. The correct answer is B. Proceed with the acquisition after a cursory review of the target company's regulatory history, assuming the past infractions are minor and unlikely to impact the deal's approval. Explanation. This scenario presents a professional challenge due to the inherent conflict between a company's desire for rapid growth and the stringent regulatory requirements designed to protect investors and market integrity. Asahi Group, like any publicly traded entity, must navigate these complexities while upholding its legal and ethical obligations. The core of the challenge lies in ensuring that any expansion strategy, particularly one involving the acquisition of a new entity, is conducted with full transparency and adherence to all applicable securities laws and corporate governance principles. A failure to do so can lead to severe penalties, reputational damage, and loss of investor confidence. The correct approach involves a thorough and documented due diligence process that explicitly considers the regulatory implications of the acquisition. This includes verifying the target company's compliance history, identifying any potential regulatory hurdles, and ensuring that Asahi Group's internal controls are sufficient to manage the integrated entity. This approach is correct because it prioritizes regulatory compliance and risk mitigation, which are fundamental tenets of responsible corporate behavior and are mandated by securities regulations aimed at preventing market manipulation and protecting shareholders. It demonstrates a commitment to operating within the legal framework, thereby safeguarding the company and its stakeholders. An incorrect approach that focuses solely on the financial benefits of the acquisition without adequately assessing regulatory risks is professionally unacceptable. This failure stems from a disregard for legal obligations, potentially exposing Asahi Group to fines, sanctions, and legal challenges. Another incorrect approach, which involves making assumptions about the target company's regulatory standing without independent verification, is equally flawed. This demonstrates a lack of diligence and a willingness to proceed without sufficient information, violating principles of good corporate governance and potentially leading to unforeseen compliance issues. Finally, an approach that delays or omits necessary regulatory filings or approvals, even with the intention of expediting the deal, constitutes a direct breach of securities laws and ethical standards, undermining the integrity of the financial markets. Professionals should employ a decision-making framework that begins with a comprehensive understanding of the relevant regulatory landscape. This involves proactive identification of all applicable laws and guidelines, followed by a systematic assessment of how the proposed action, in this case, an acquisition, interacts with these regulations. A risk-based approach is crucial, where potential compliance issues are identified, evaluated, and mitigated before proceeding. Transparency, thorough documentation, and seeking expert legal and compliance advice are essential components of this framework, ensuring that all decisions are informed, defensible, and aligned with both legal requirements and ethical principles. Question 7. Quality control measures reveal that the current process for analyzing client feedback data at Asahi Group may inadvertently expose personally identifiable information during the review by the internal quality assurance team. Which of the following approaches best ensures compliance with regulatory requirements for data protection and client confidentiality? Option A. Anonymize all client feedback data by removing any direct or indirect identifiers before it is shared with the quality assurance team for analysis. Option B. Share the raw, unedited client feedback data with the quality assurance team, relying on their professional discretion to handle sensitive information appropriately. Option C. Suspend all client feedback analysis until a new, more secure system for data handling can be developed and implemented. Option D. Provide the quality assurance team with a brief training session on data privacy and then share the raw client feedback data for their review. Correct answer is A. Anonymize all client feedback data by removing any direct or indirect identifiers before it is shared with the quality assurance team for analysis. Explanation. This scenario presents a professional challenge due to the potential for Asahi Group to inadvertently breach regulatory requirements concerning the handling of sensitive client information. The core difficulty lies in balancing the need for efficient internal communication and data analysis with the stringent obligations to protect client confidentiality and data integrity, as mandated by the relevant regulatory framework. A failure to adhere to these regulations can lead to significant reputational damage, financial penalties, and loss of client trust. The correct approach involves implementing a robust data anonymization process before any data is shared for quality control analysis. This method is correct because it directly addresses the regulatory requirement to protect client privacy and sensitive information. By anonymizing the data, Asahi Group ensures that individual clients cannot be identified, thereby mitigating the risk of a data breach or misuse of personal information. This aligns with the principles of data protection and confidentiality enshrined in the relevant regulatory framework, which prioritizes safeguarding client data. An approach that involves sharing raw, identifiable client data with the quality control team for analysis is incorrect. This constitutes a direct violation of data protection regulations, as it exposes sensitive client information without proper consent or anonymization. Such an action would create a significant risk of unauthorized access, disclosure, or misuse of personal data, leading to severe regulatory penalties and reputational harm. Another incorrect approach would be to delay or forego the quality control analysis altogether due to concerns about data privacy. While well-intentioned, this is professionally unsound as it undermines the company's commitment to service quality and operational efficiency. Regulatory frameworks often expect firms to maintain high standards of service and internal controls, which includes robust quality assurance processes. Avoiding necessary analysis due to an inability to implement it compliantly suggests a deficiency in internal processes and risk management. Finally, an approach that relies on informal, verbal assurances of confidentiality from the quality control team without implementing technical or procedural safeguards is also incorrect. While trust is important, regulatory compliance demands demonstrable and verifiable controls. Verbal assurances do not constitute a sufficient safeguard against data breaches and would not satisfy regulatory scrutiny in the event of an incident. Professionals should adopt a proactive and risk-based decision-making framework. This involves identifying potential regulatory compliance issues early, understanding the specific requirements of the applicable regulatory framework, and developing and implementing controls that demonstrably meet those requirements. When faced with a conflict between operational needs and regulatory obligations, the priority must always be to find a compliant solution that upholds regulatory standards while still achieving business objectives. This often involves consulting with compliance officers and legal counsel to ensure all actions are fully compliant. Question 8. To address the challenge of a potential, unconfirmed acquisition that could significantly impact Asahi Group's market valuation, what is the most appropriate regulatory compliance approach for Asahi Group's management to undertake? Option A. Initiate immediate public disclosure of the potential acquisition, even if negotiations are in their early stages and the outcome is uncertain, to ensure maximum transparency. Option B. Inform key institutional investors and financial analysts about the potential acquisition to gauge market reaction before making a public announcement. Option C. Conduct a thorough internal assessment of the acquisition's potential materiality and consult with legal counsel to determine the appropriate timing and method for public disclosure, adhering to all regulatory requirements. Option D. Continue negotiations in secrecy, only disclosing the acquisition once a definitive agreement has been reached and all terms are finalized. The correct answer is A. Initiate immediate public disclosure of the potential acquisition, even if negotiations are in their early stages and the outcome is uncertain, to ensure maximum transparency. Explanation. This scenario presents a professional challenge because Asahi Group, as a publicly listed entity, is subject to stringent regulatory requirements regarding the disclosure of material information. The core difficulty lies in balancing the need for timely and accurate communication with stakeholders against the risk of premature or incomplete disclosure that could mislead the market or create unfair advantages. Careful judgment is required to determine what constitutes material information and when it must be disclosed. The correct approach involves a thorough internal assessment of the potential acquisition's impact on Asahi Group's business, financial condition, and stock price. This assessment must be conducted by appropriate personnel, likely involving legal, finance, and senior management. Once the information is confirmed as material, Asahi Group must adhere to the disclosure obligations mandated by the relevant securities regulators. This typically means making a public announcement promptly, and in a manner that ensures broad and equitable dissemination of the information to all investors. The regulatory framework, such as the rules governing listed companies and insider trading, requires transparency to maintain market integrity and investor confidence. An incorrect approach would be to delay disclosure indefinitely while continuing negotiations, hoping for a more favorable outcome. This failure to disclose material information in a timely manner can violate securities laws, leading to regulatory penalties and reputational damage. Another incorrect approach is to selectively disclose the information to a limited group of individuals, such as certain analysts or institutional investors, before a public announcement. This constitutes selective disclosure or tipping, which is a serious breach of insider trading regulations and undermines the principle of fair and equal access to information for all market participants. Finally, making a premature or speculative announcement without sufficient confirmation or detail could also be problematic. While aiming for promptness, the disclosure must be accurate and complete enough to avoid misleading the market. This can lead to accusations of market manipulation or misrepresentation. Professionals should employ a structured decision-making process that begins with identifying potential material information. This should be followed by an internal consultation with legal and compliance teams to assess materiality and disclosure obligations. A robust internal control system should be in place to manage the flow of sensitive information and prevent unauthorized disclosure. When in doubt about materiality or disclosure timing, seeking guidance from legal counsel and regulatory experts is paramount. The ultimate goal is to ensure compliance with all applicable laws and regulations, while upholding ethical standards of transparency and fairness. Question 9. The review process indicates that a key client of Asahi Group has requested access to proprietary market research data that has not yet been publicly released, stating it is crucial for their immediate investment decisions. Asahi Group's internal policy strictly prohibits the dissemination of such information prior to its official publication. Which of the following represents the most appropriate course of action for Asahi Group in this situation? Option A. Share a summary of the proprietary market research data with the client, omitting any specific figures or sensitive details to provide some assistance without fully disclosing the information. Option B. Advise the client that the information is sensitive and cannot be shared, but suggest they consult external sources that may have similar, albeit less precise, data. Option C. Inform the client that the requested information cannot be shared until it is publicly released, and offer to provide the data immediately upon its official publication, while also exploring if any publicly available information can assist their current decision-making. Option D. Provide the client with the proprietary market research data with a strict confidentiality agreement to maintain the client relationship and ensure their continued business. The correct answer is C. Inform the client that the requested information cannot be shared until it is publicly released, and offer to provide the data immediately upon its official publication, while also exploring if any publicly available information can assist their current decision-making. Explanation. This scenario presents a professional challenge due to the inherent conflict between a client's request and the regulatory obligations of Asahi Group. The need for careful judgment arises from balancing client satisfaction with the imperative to uphold compliance standards, which are paramount in maintaining the integrity of financial services and protecting investors. The correct approach involves a thorough understanding and application of the relevant regulatory framework governing client interactions and the handling of sensitive information. Specifically, it requires Asahi Group to adhere to guidelines that mandate transparency, prevent conflicts of interest, and ensure that all client communications and actions are documented and compliant. This approach is correct because it prioritizes regulatory adherence and ethical conduct, safeguarding both the firm and its clients from potential legal repercussions and reputational damage. It demonstrates a commitment to operating within the established legal and ethical boundaries, which is a fundamental requirement for any financial institution. An incorrect approach would be to accede to the client's request without proper due diligence or consideration of regulatory implications. This could involve sharing non-public information or engaging in practices that could be construed as market manipulation or insider trading. Depending on the specific nature of the information and the client's intent, such actions would directly violate regulatory principles of fairness, market integrity, and confidentiality. Another incorrect approach would be to dismiss the client's request outright without offering a compliant alternative or explanation. While this avoids direct regulatory breach, it fails to demonstrate a commitment to client service and could lead to client dissatisfaction and potential loss of business without adequately addressing the underlying regulatory concern. A third incorrect approach might involve attempting to circumvent regulations by using ambiguous language or indirect methods to fulfill the client's request. This is ethically unsound and still carries significant regulatory risk, as regulators often look beyond the surface to the substance of actions. Professionals should employ a decision-making framework that begins with identifying the core request and then immediately cross-referencing it against all applicable regulations and internal policies. If a conflict is identified, the next step is to seek clarification from compliance or legal departments. The focus should always be on finding a compliant solution that meets the client's legitimate needs without compromising regulatory integrity. If no compliant solution exists, the firm must clearly communicate this to the client, explaining the regulatory reasons for the inability to fulfill the request. Question 10. What factors determine the appropriate regulatory compliance strategy for Asahi Group's new product launch advertising campaign, considering recent updates to consumer protection guidelines? Option A. Proceeding with the campaign if no specific regulation directly prohibits the proposed advertising claims, based on a broad interpretation of permissible marketing activities. Option B. Relying on the advertising team's historical understanding of successful campaigns and assuming that existing marketing practices are still compliant. Option C. A comprehensive review of the new product launch advertising materials against the most recent consumer protection guidelines and any relevant industry codes of conduct, followed by internal legal and compliance team approval. Option D. Prioritizing the speed of the product launch to gain market advantage, with a post-launch review of compliance if any issues arise. The correct answer is C. A comprehensive review of the new product launch advertising materials against the most recent consumer protection guidelines and any relevant industry codes of conduct, followed by internal legal and compliance team approval. Explanation. This scenario presents a common challenge in regulatory compliance where a company, Asahi Group, must navigate evolving guidelines to ensure its marketing practices remain lawful and ethical. The professional challenge lies in interpreting and applying potentially ambiguous or newly introduced regulations to real-world marketing campaigns, balancing commercial objectives with legal obligations. This requires a nuanced understanding of the relevant regulatory framework and the ability to foresee potential compliance risks. The correct approach involves a proactive and thorough review of the specific marketing materials against the latest regulatory guidance issued by the relevant authority. This ensures that Asahi Group's campaigns are not only compliant with current laws, but also align with the spirit of consumer protection and fair competition emphasized by the regulators. This approach is ethically sound and legally defensible, minimizing the risk of penalties, reputational damage, and consumer complaints. An incorrect approach would be to rely solely on past practices or general industry standards without verifying their current compliance status. This fails to acknowledge the dynamic nature of regulations and could lead to inadvertent violations. Another incorrect approach is to assume that if a practice has not been explicitly prohibited, it is permissible. This overlooks the principle of regulatory intent and the potential for broader interpretations of existing rules. Finally, prioritizing speed to market over thorough compliance review is a significant ethical and legal failing, demonstrating a disregard for regulatory obligations and potentially exposing Asahi Group to severe consequences. Professionals should adopt a decision-making framework that prioritizes understanding the specific regulatory requirements, assessing the potential risks associated with each marketing activity, seeking expert advice when necessary, and implementing robust internal controls to ensure ongoing compliance. This proactive and diligent approach is crucial for maintaining Asahi Group's integrity and operational sustainability. Question 11. Process analysis reveals that Asahi Group is considering a strategic acquisition in a new international market. To expedite the integration and realize synergy benefits quickly, the internal strategy team proposes prioritizing the operational and financial aspects of the acquisition, with regulatory review to be conducted concurrently, but with less emphasis, assuming that standard compliance procedures will suffice. Which of the following approaches best aligns with regulatory compliance requirements for Asahi Group? Option A. Delegate the regulatory review to the acquired company's existing compliance team, trusting their knowledge of local regulations without independent verification by Asahi Group's internal compliance department or external advisors. Option B. Conduct a thorough and proactive regulatory due diligence process specific to the target market and the nature of the acquisition, engaging local legal and compliance experts to identify all applicable laws, regulations, and potential risks before finalizing the acquisition. Option C. Proceed with the acquisition based on the assumption that Asahi Group's existing compliance framework is universally applicable and sufficient for any new market, deferring detailed regulatory checks until after the integration is substantially complete. Option D. Prioritize the speed of the acquisition and integration, focusing primarily on operational and financial synergies, and conduct a superficial regulatory review to ensure basic legal requirements are met, with deeper checks to be performed only if issues arise post-acquisition. The correct answer is B. Conduct a thorough and proactive regulatory due diligence process specific to the target market and the nature of the acquisition, engaging local legal and compliance experts to identify all applicable laws, regulations, and potential risks before finalizing the acquisition. Explanation. This scenario presents a professional challenge due to the inherent conflict between a company's desire for rapid growth and the stringent regulatory requirements designed to protect investors and market integrity. Asahi Group, like any publicly traded entity, must navigate this tension by ensuring all expansion activities, particularly those involving potential acquisitions or new market entries, are conducted with meticulous adherence to the relevant regulatory framework. The challenge lies in balancing strategic ambition with compliance obligations, requiring a deep understanding of the applicable laws and guidelines to avoid missteps that could lead to significant penalties, reputational damage, and operational disruption. Careful judgment is required to identify and mitigate risks proactively. The correct approach involves a comprehensive due diligence process that prioritizes regulatory compliance at every stage of the proposed expansion. This means actively seeking out and understanding all applicable laws, regulations, and industry guidelines in the target market or for the specific type of transaction. It necessitates engaging with legal and compliance experts to assess potential risks, ensure all necessary approvals are obtained, and that the expansion strategy itself is structured in a compliant manner. This proactive and thorough method is ethically sound and legally mandated, as it demonstrates a commitment to responsible business conduct and safeguards against violations that could harm stakeholders. An incorrect approach that focuses solely on speed and market opportunity without adequate regulatory consideration would be professionally unacceptable. This failure stems from a disregard for the legal framework, potentially leading to breaches of regulations concerning mergers and acquisitions, foreign investment, or market conduct. Another incorrect approach, which involves assuming existing compliance knowledge is sufficient for a new jurisdiction or transaction type, is also flawed. This demonstrates a lack of diligence and an underestimation of the complexities and specific nuances of different regulatory environments. Such assumptions can result in overlooking critical requirements, leading to noncompliance. A third incorrect approach, which delays or omits seeking expert legal and compliance advice, is a direct abdication of professional responsibility. This can lead to significant legal liabilities and reputational damage, as it bypasses the essential checks and balances designed to ensure lawful operation. Professionals should adopt a decision-making framework that begins with a clear understanding of the regulatory landscape relevant to the proposed action. This involves identifying all applicable laws, regulations, and guidelines. Subsequently, a risk assessment should be conducted, focusing on potential compliance gaps and their implications. Seeking expert advice from legal and compliance professionals is a crucial step. Finally, integrating compliance considerations into the strategic planning and execution phases ensures that business objectives are pursued responsibly and lawfully. Question 12. The control framework reveals that a senior executive at Asahi Group is in discussions with a potential new client. During these discussions, the executive inadvertently learns of significant, non-public information regarding a competitor's upcoming product launch that could materially impact the competitor's stock price. The executive believes this information could be used to leverage a more favorable deal for Asahi Group with the potential client, who is also invested in the competitor. What is the most appropriate course of action for the executive to take? Option A. Proceed with the discussions, subtly using the information to secure the best possible deal for Asahi Group, assuming the information is not yet public. Option B. Immediately cease all discussions with the potential client and report the information and the situation to the Asahi Group Compliance Department for guidance. Option C. Inform the potential client of the information, suggesting they might want to act on it before it becomes public, to foster goodwill. Option D. Conduct further independent research to confirm the materiality and public availability of the information before reporting it to compliance. The correct answer is B. Immediately cease all discussions with the potential client and report the information and the situation to the Asahi Group Compliance Department for guidance. Explanation. This scenario presents a professional challenge due to the inherent conflict between a business objective, securing a new client for Asahi Group, and the regulatory imperative to maintain market integrity and prevent insider trading. The pressure to close a deal can sometimes lead individuals to overlook or downplay potential risks, making careful judgment and adherence to compliance protocols paramount. The correct approach involves proactively seeking guidance from the compliance department and refraining from any action that could be construed as market abuse. This aligns with the fundamental principles of regulatory compliance, specifically the prohibition of insider dealing and the obligation to report potential conflicts of interest or breaches of regulations. By engaging compliance, Asahi Group demonstrates a commitment to upholding the law and protecting its reputation, which is a core ethical and regulatory requirement for all financial institutions. An incorrect approach of proceeding with the deal without addressing the insider information concern would constitute a serious regulatory failure. This would directly violate prohibitions against insider trading, as it involves acting on material non-public information. Ethically, it undermines fair market practices and could lead to significant reputational damage and legal penalties for Asahi Group and the individuals involved. Another incorrect approach of dismissing the concern as a minor detail and proceeding with the deal would also be a significant ethical and regulatory lapse. This demonstrates a disregard for compliance procedures and a failure to appreciate the gravity of potential insider information. It prioritizes short-term business gains over long-term regulatory adherence and market integrity. A further incorrect approach of attempting to verify the information independently without involving compliance or legal counsel is also problematic. While due diligence is important, attempting to circumvent established compliance channels for sensitive information can create further risks and may not be sufficient to absolve individuals of responsibility if a breach occurs. The proper procedure is to escalate such matters through the designated compliance channels. The professional decision-making process for similar situations should involve a clear understanding of the firm's compliance policies and relevant regulation. When faced with a situation that raises even a suspicion of potential regulatory breach, the immediate step should be to pause any action that could be affected and consult with the compliance department. This ensures that decisions are made with full awareness of legal and ethical obligations, safeguarding both the individual and the firm from regulatory sanctions and reputational harm. Question 13. System analysis indicates that an employee at Asahi Group has overheard a conversation detailing a significant upcoming product recall that has not yet been publicly announced. This information, if true, would likely have a material impact on Asahi Group's stock price. What is the most appropriate course of action for this employee to take to ensure compliance with regulatory frameworks governing insider trading? Option A. Discuss the overheard information with a close friend who is also an investor. Option B. Wait a few days to see if the information appears in financial news outlets before making any decisions. Option C. Refrain from trading or communicating the information and seek guidance from Asahi Group's compliance department. Option D. Immediately sell any Asahi Group stock they own to avoid potential losses. The correct answer is D. Immediately sell any Asahi Group stock they own to avoid potential losses. Explanation. Scenario analysis. This scenario presents a professional challenge for an employee at Asahi Group concerning the handling of potentially material non-public information. The core difficulty lies in balancing the need to act on information that could impact investment decisions with the strict regulatory prohibition against insider trading. Employees are entrusted with sensitive information, and a misstep can lead to severe legal penalties, reputational damage for both the individual and Asahi Group, and a breach of trust with the market. Careful judgment is required to discern when information is truly public and when it remains confidential and therefore restricted. Correct approach analysis. The correct approach involves verifying the public availability of the information before taking any action. This aligns with the fundamental principle of market integrity, which mandates that all investors should have access to the same material information simultaneously. By confirming that the information has been officially disclosed through appropriate channels, e.g., regulatory filings, press releases, an employee ensures they are not acting on privileged knowledge. This adheres to the spirit and letter of insider trading regulations, which are designed to prevent unfair advantages and maintain a level playing field for all market participants. Incorrect approach is analysis. Acting on the information immediately without verification represents a failure to comply with insider trading regulations. This approach assumes the information is already public or that the risk of it being non-public is negligible, which is a dangerous assumption. The regulatory framework strictly prohibits trading on material non-public information, regardless of the employee's intent or perceived likelihood of discovery. Sharing the information with a trusted friend or family member before it is public is also a serious breach. This constitutes tipping, which is a form of insider trading. The law extends liability not only to those who trade on inside information, but also to those who disclose it to others who may then trade. This action directly violates the duty of confidentiality and the prohibition against disseminating material non-public information. Waiting for a few days to see if the information appears in the news before acting is insufficient. The critical factor is not the passage of time, but the official and widespread dissemination of the information. Information can remain non-public for extended periods, and even a few days can be enough to constitute illegal insider trading if the information is still not officially public. This approach demonstrates a misunderstanding of the immediacy required for information to be considered truly public and therefore permissible for trading. Professional reasoning. Professionals at Asahi Group must adopt a proactive and cautious approach to information handling. When in doubt about the public status of information that could be considered material, the default position should always be to assume it is non-public and therefore restricted. A robust decision-making process involves 1. Identifying potentially material information. 2. Assessing its current dissemination status. 3. If there is any uncertainty, seeking clarification from the compliance department or legal counsel. And 4. Refraining from any trading or communication of the information until its public availability is unequivocally confirmed through official channels. This systematic approach safeguards against regulatory breaches and upholds ethical standards. Question 14. Market research demonstrates a significant shift in consumer preference towards a new product category that Asahi Group is considering entering. A junior analyst within Asahi Group's marketing department has obtained a detailed report from an independent market research firm. However, the analyst also mentions that a contact at a competitor company, who is a friend, has shared some preliminary insights that align with the report's findings. Asahi Group's management is eager to leverage this information to accelerate their market entry strategy. Which of the following approaches best aligns with regulatory compliance and ethical conduct for Asahi Group? Option A. Commission a new, independent market research study from a different firm to validate the initial report and instruct the junior analyst to cease all communication with their competitor contact. Option B. Proceed with the market entry strategy based on the independent market research report, while disregarding the competitor's preliminary insights as informal and unverified. Option C. Utilize the independent market research report for strategic planning, but also discreetly incorporate the competitor's preliminary insights into the strategy, assuming they are corroborative and not material non-public information. Option D. Immediately cease all use of the independent market research report and the competitor's insights, and initiate an internal investigation into the source of the competitor's information. The correct answer is B. Proceed with the market entry strategy based on the independent market research report, while disregarding the competitor's preliminary insights as informal and unverified. Explanation. This scenario presents a professional challenge due to the inherent conflict between Asahi Group's desire to leverage market insights for competitive advantage and the stringent regulatory requirements governing the use of non-public information. Navigating this requires a deep understanding of insider trading laws and ethical conduct, ensuring that any information utilized is lawfully obtained and does not confer an unfair advantage. The core of the challenge lies in distinguishing between legitimate market analysis and the misuse of privileged information. The correct approach involves Asahi Group's compliance department meticulously reviewing the source and nature of the market research data. This ensures that the information is publicly available or has been lawfully acquired through appropriate channels, such as independent third-party research firms that do not have access to Asahi Group's material non-public information. This adherence to regulatory frameworks, such as those prohibiting insider trading and mandating fair market practices, is paramount. By verifying the legitimacy of the data, Asahi Group upholds its ethical obligations and avoids potential legal repercussions, safeguarding its reputation and the integrity of the market. An incorrect approach would be to proceed with the market research findings without rigorous verification of their source and legality. This could lead to the inadvertent use of material non-public information, constituting a breach of insider trading regulations. Another incorrect approach would be to rely on information obtained from employees of other publicly traded companies who may have access to confidential details about their respective firms. This directly violates the principle of fair trading and could expose Asahi Group to severe penalties. Furthermore, assuming that any information labeled market research is automatically permissible without due diligence is a significant ethical and regulatory failing, as it bypasses the necessary checks and balances designed to maintain market fairness. Professionals facing similar situations should adopt a robust decision-making framework that prioritizes regulatory compliance and ethical conduct. This framework should include 1. Information verification. Always scrutinize the source and nature of any information, especially if it appears to provide a significant competitive edge. 2. Legal consultation. When in doubt about the legality or ethical implications of using certain information, consult with the legal and compliance departments. 3. Policy adherence. Strictly follow internal company policies and external regulatory guidelines regarding information handling and trading. 4. Risk assessment. Continuously assess the potential risks associated with the use of any information, including legal, reputational, and financial consequences. Question 15. Market research demonstrates that during a routine analysis of competitor financial reports, an Asahi Group analyst discovers a significant, undisclosed product development breakthrough by a key rival. This information is not yet public, and if acted upon, could provide a substantial trading advantage. Which of the following actions best aligns with Asahi Group's regulatory obligations and ethical standards? Option A. Immediately cease any personal or company trading activities related to the competitor's stock. Report the discovery to Asahi Group's compliance department, and refrain from further discussion or use of the information. Option B. Proceed with personal trading based on the anticipated market reaction to the news once it becomes public, assuming the information will eventually be disclosed. Option C. Share the information with trusted colleagues within Asahi Group who are also involved in market analysis to gauge its potential impact on Asahi Group's strategy. Option D. Continue with the market research as planned, disregarding the information as it was obtained through legitimate research channels, and wait for the competitor to make a public announcement. The correct answer is A. Immediately cease any personal or company trading activities related to the competitor's stock, report the discovery to Asahi Group's compliance department, and refrain from further discussion or use of the information. Explanation. This scenario presents a professional challenge for Asahi Group employees due to the inherent conflict between competitive market intelligence gathering and the ethical and regulatory obligations to avoid insider trading and market manipulation. The need for careful judgment arises from the fine line between legitimate research and the misuse of non-public information. The correct approach involves strictly adhering to Asahi Group's internal policies and relevant regulatory guidelines concerning the handling of market-sensitive information. This means any information obtained through market research must be publicly available or derived from public sources. If during research, an employee inadvertently encounters material non-public information, MNPI, about a competitor or the market, the professional obligation is to immediately cease any trading activity based on that information, report it internally according to established procedures, and refrain from further discussion or dissemination of the MNPI. This approach is ethically sound and legally compliant, preventing Asahi Group from engaging in or being perceived to engage in insider trading or market manipulation, thereby safeguarding its reputation and avoiding severe penalties. An incorrect approach of acting on or disseminating the MNPI obtained during research would constitute a serious regulatory and ethical failure. This would directly violate insider trading laws, which prohibit trading securities on the basis of MNPI. It would also breach market manipulation regulations, as using such information to influence market prices or trading volumes is illegal. Furthermore, it would contravene Asahi Group's internal code of conduct and ethical standards, leading to disciplinary action, reputational damage, and potential legal liabilities for both the individual and the company. Another incorrect approach of ignoring the MNPI and continuing with business as usual without reporting, it internally also carries significant risks. While not directly trading on the information, the knowledge of MNPI can subconsciously influence decision-making, leading to actions that, while not explicitly illegal, could still be seen as leveraging an unfair informational advantage. More importantly, failing to report MNPI internally prevents the company from taking appropriate steps to contain the information and ensure compliance, potentially exposing Asahi Group to regulatory scrutiny if the information later becomes public and its prior possession by an employee is discovered. The professional decision-making process for similar situations should involve a clear understanding of what constitutes MNPI, a commitment to adhering to internal policies and external regulations, and a proactive approach to reporting any potential breaches. When faced with potentially sensitive information, professionals should ask, is this information publicly available? If not, is it material? If it is material and non-public, what are the immediate steps required by company policy and regulation? This involves pausing, documenting, reporting, and seeking guidance from compliance or legal departments before taking any further action. Question 16. Compliance review shows that a senior manager at Asahi Group, responsible for a significant procurement decision, has a close personal friendship with a key executive of a vendor company that is bidding for a substantial contract. The senior manager has not disclosed this relationship to their superiors or the compliance department. What is the most appropriate course of action for the compliance officer who becomes aware of this situation? Option A. Advise the senior manager to immediately disclose the personal relationship to their direct supervisor and the compliance department, and recuse themselves from any part of the decision-making process related to the vendor. Option B. Suggest to the senior manager that the friendship is unlikely to influence their professional judgment, and they can proceed with the procurement decision as normal. Option C. Recommend that the senior manager discreetly gather more information about the vendor's bid to ensure fairness before making a decision. Option D. Encourage the senior manager to discuss the situation informally with a trusted colleague in another department to gauge their opinion on how to proceed. The correct answer is A. Advise the senior manager to immediately disclose the personal relationship to their direct supervisor and the compliance department, and recuse themselves from any part of the decision-making process related to the vendor. Explanation. This scenario presents a professional challenge due to the potential for conflicts of interest and the need to uphold Asahi Group's commitment to fair and transparent dealings. The compliance officer must navigate the delicate balance between fostering positive business relationships and ensuring that all actions align with the company's ethical standards and relevant regulatory guidelines. The core of the challenge lies in identifying and mitigating situations where personal relationships or perceived obligations could unduly influence business decisions, thereby compromising integrity. The correct approach involves a proactive and transparent disclosure process. By immediately reporting the potential conflict of interest to the appropriate internal authority, the compliance officer demonstrates adherence to Asahi Group's internal policies and ethical codes, which typically mandate such disclosures. This allows for an objective review and management of the situation, ensuring that any decision-making process remains impartial and free from undue influence. This aligns with the principle of maintaining a robust compliance framework that prioritizes ethical conduct and prevents even the appearance of impropriety. An incorrect approach of proceeding with the business discussion without disclosure risks violating Asahi Group's conflict of interest policy. This failure to report could be interpreted as an attempt to conceal a potential bias, undermining trust, and potentially leading to decisions that are not in the best interest of the company. Another incorrect approach of downplaying the relationship's significance and proceeding without formal disclosure is equally problematic. It demonstrates a lack of understanding of the importance of transparency in compliance and the potential for even seemingly minor personal connections to create perceived or actual conflicts. This approach fails to uphold the ethical standard of avoiding situations that could compromise professional judgment. A further incorrect approach of seeking informal advice from a colleague without involving the designated compliance or legal department bypasses established reporting channels and may not provide the comprehensive guidance needed to navigate complex ethical considerations, potentially leading to an inadequate resolution. Professionals should adopt a decision-making process that begins with identifying any potential conflict of interest, no matter how minor it may seem. This should be followed by a thorough review of the company's internal policies and relevant regulatory guidelines. The next critical step is to proactively and transparently report the potential conflict to the designated authority within the organization. This ensures that the situation is managed appropriately and that decisions are made with integrity and in the best interest of the company. Question 17. The monitoring system demonstrates a pattern of unusual trading activity in Asahi Group's securities by several employees shortly before a significant, yet unannounced, product development breakthrough. Which of the following represents the most appropriate immediate response by the compliance department? Option A. Initiate a formal, documented internal investigation to gather all relevant facts, assess the potential for insider trading, and consult Asahi Group's internal policies and relevant regulatory guidelines before any external reporting. Option B. Classify the trading activity as routine and unrelated to any non-public information, given the employee's general access to company information. Option C. Immediately report the suspicious trading activity to the relevant financial regulatory authorities without conducting any internal review. Option D. Directly question the employees involved about their trading decisions in an informal manner to gauge their reactions. The correct answer is A. Initiate a formal, documented internal investigation to gather all relevant facts, assess the potential for insider trading, and consult Asahi Group's internal policies and relevant regulatory guidelines before any external reporting. Explanation. This scenario presents a professional challenge because it requires an immediate and accurate assessment of potential market abuse, specifically insider dealing, within Asahi Group. The monitoring system has flagged unusual trading activity that, if not handled correctly, could lead to significant regulatory penalties, reputational damage, and erosion of market confidence. The core of the challenge lies in distinguishing between legitimate trading patterns and those that might be influenced by non-public information, necessitating a robust and compliant response. The correct approach involves a thorough, documented investigation that adheres strictly to Asahi Group's internal policies and relevant regulatory guidelines. This approach prioritizes gathering all necessary facts, including the nature of the flagged trades, the individuals involved, and any potential connection to material non-public information. It then involves escalating the findings through the appropriate channels for further review and potential reporting to regulatory authorities. This methodical process ensures that any action taken is based on evidence, minimizes the risk of false accusation, and fulfills the company's regulatory obligations to detect and prevent market abuse. This aligns with the principles of market integrity and the duty of care expected of financial institutions and their employees. An incorrect approach that involves immediately reporting the activity to regulators without a preliminary internal investigation is flawed. This bypasses the company's responsibility to conduct its own due diligence, potentially leading to unnecessary regulatory scrutiny and wasted resources for both the company and the authorities. It also fails to protect individuals from unfounded accusations if the trading activity is ultimately deemed legitimate. Another incorrect approach, which is to dismiss the flagged activity as insignificant without further inquiry, is also professionally unacceptable. This demonstrates a disregard for the monitoring system's purpose and a failure to uphold the company's commitment to market integrity. Such inaction could allow genuine insider dealing to go undetected, leading to severe regulatory sanctions and reputational harm for Asahi Group. A third incorrect approach, which is to confront the individuals involved directly and informally without a structured investigation, is problematic. While seemingly proactive, this can compromise the integrity of any subsequent formal investigation, alert potential wrongdoers, and may not be conducted in a manner that preserves evidence or adheres to due process. It also risks making unsubstantiated accusations that could lead to legal challenges. A professional decision-making process for similar situations should involve a clear protocol for handling suspicious trading alerts. This protocol should mandate an initial assessment, followed by a detailed, documented investigation if the alert warrants it. Key steps include identifying the source of the alert, reviewing the trading patterns and associated individuals, assessing the potential for access to material non-public information, and escalating findings to the appropriate compliance or legal teams. Transparency and documentation are paramount throughout the process to ensure accountability and compliance with regulatory requirements. Question 18. The performance metrics show a significant disparity in client acquisition rates between two teams within Asahi Group's operations. One team consistently exceeds targets, while the other lags considerably. The lagging team's manager proposes implementing a new, aggressive client outreach strategy that involves offering preferential, non-public investment insights to potential new clients to incentivize account opening. Option A. The manager should immediately report this proposed strategy to the compliance department for review against Asahi Group's regulatory obligations and internal code of conduct before any implementation. Option B. The manager should instruct the lagging team to adopt the successful strategies of the top-performing team without further investigation into the new proposal. Option C. The manager should implement the new strategy on a trial basis with a small group of clients to gauge its effectiveness before a wider rollout. Option D. The manager should proceed with the new strategy, as the potential for increased client acquisition outweighs the minor risk of regulatory scrutiny. The correct answer is A. The manager should immediately report this proposed strategy to the compliance department for review against Asahi Group's regulatory obligations and internal code of conduct before any implementation. Explanation: this scenario presents a professional challenge because it requires balancing the pursuit of business objectives with adherence to regulatory requirements and ethical conduct. Asahi Group, like any financial institution, operates within a strict regulatory environment designed to protect investors and maintain market integrity. The challenge lies in interpreting performance data and making decisions that are not only commercially sound, but also compliant with the Asahi Group hiring assessment tests specified regulatory framework. Careful judgment is required to avoid actions that could lead to regulatory breaches, reputational damage, or harm to clients. The correct approach involves a thorough review of the performance metrics in conjunction with the relevant regulatory guidelines and internal policies of Asahi Group. This approach prioritizes compliance and ethical considerations. By understanding the specific regulations governing performance evaluation and incentive structures within the Asahi Group's operational jurisdiction, an individual can ensure that any proposed actions are both effective and lawful. This demonstrates a commitment to responsible business practices and upholds the trust placed in Asahi Group by its stakeholders. An incorrect approach that focuses solely on maximizing short-term gains without considering regulatory implications is professionally unacceptable. This could lead to actions that violate rules regarding fair competition, data privacy, or client suitability, resulting in penalties, legal action, and damage to Asahi Group's reputation. Another incorrect approach that involves overlooking potential conflicts of interest or engaging in practices that could be perceived as misleading to clients or regulators is also a failure. Such actions undermine the principles of transparency and integrity essential in the financial services industry. Professionals should employ a decision-making framework that begins with identifying the core issue and the relevant regulatory and ethical principles. This is followed by gathering all necessary information, including performance data and applicable rules. Then, potential courses of action are evaluated against these principles and rules. The chosen course of action should be the one that best aligns with both business objectives and regulatory compliance, ensuring that all decisions are defensible and uphold the highest professional standards. Question 19. Compliance review shows that a key supplier to Asahi Group has offered a senior procurement manager a high-value, branded electronic device as a token of appreciation for a recent successful contract negotiation. The manager is unsure how to proceed. Which of the following represents the most appropriate course of action for the procurement manager? Option A. Immediately accept the gift as a gesture of goodwill and a sign of a strong business relationship. Option B. Accept the gift and use it personally, as it is a common practice in the industry. Option C. Politely decline the gift, explaining that Asahi Group has strict policies against accepting gifts of significant value from suppliers. Option D. Accept the gift and inform the supplier that Asahi Group's policies require such gifts to be declared and potentially returned or donated. The correct answer is D. Accept the gift and inform the supplier that Asahi Group's policies require such gifts to be declared and potentially returned or donated. Explanation: this scenario presents a professional challenge due to the potential for conflicts of interest and the need to uphold Asahi Group's commitment to fair and transparent dealings with its suppliers. Navigating these situations requires a keen understanding of ethical principles and the specific regulatory framework governing business conduct, particularly concerning gifts and entertainment. The core of the challenge lies in balancing legitimate business relationship building with the imperative to avoid even the appearance of impropriety that could compromise decision-making or create undue influence. The correct approach involves a thorough assessment of the gift's nature, value, and context against Asahi Group's internal policies and relevant regulations. This approach prioritizes transparency and adherence to established guidelines. Specifically, it requires evaluating whether the gift falls within acceptable parameters for business courtesies, considering its potential to influence business decisions, and ensuring proper disclosure and approval processes are followed. This aligns with the ethical imperative to maintain integrity and prevent corruption, as often mandated by corporate codes of conduct and broader anti-bribery legislation. An incorrect approach would be to accept the gift without proper consideration or disclosure, assuming it is a standard business practice. This fails to acknowledge the potential for the gift to create a conflict of interest or to be perceived as an attempt to improperly influence business outcomes. Such an action could violate Asahi Group's internal policies on gifts and entertainment, and potentially contravene regulations that prohibit offering or accepting inducements to secure business advantages. Another incorrect approach would be to immediately reject the gift without any attempt to understand its intent or to communicate with the supplier. Caution is warranted. An overly rigid or dismissive response could damage a valuable supplier relationship unnecessarily. It also misses an opportunity to clarify expectations and reinforce Asahi Group's ethical standards in a constructive manner. This approach lacks the nuanced judgment required for effective stakeholder management. A third incorrect approach would be to accept the gift and keep it without any form of reporting or documentation. This is a direct violation of transparency requirements and creates a significant risk of appearing to conceal a potential conflict of interest. It undermines the integrity of internal controls and could lead to serious reputational damage for both the individual and Asahi Group. The professional decision-making process for similar situations should involve a structured assessment. First, understanding Asahi Group's specific policies on gifts and entertainment. Second, evaluating the gift's characteristics, value, nature, timing in light of these policies. Third, considering the potential impact on business decisions and relationships. And finally, consulting with the appropriate internal compliance or legal department if there is any ambiguity or concern. This systematic approach ensures that actions are both compliant and ethically sound, protecting the interests of Asahi Group and its stakeholders. Question 20. Operational review demonstrates that a sales team at Asahi Group is under significant pressure to meet quarterly targets. To expedite client onboarding and secure deals, the team is considering using simplified product descriptions in their client presentations that omit certain technical specifications and potential limitations, which are detailed in the official product documentation governed by the Asahi Group Hiring Assessment Tests regulatory framework. Which of the following approaches best aligns with professional conduct and regulatory compliance for the Asahi Group sales team? Option A. Utilize simplified product descriptions that highlight benefits and omit technical specifications or limitations to accelerate the sales process and meet targets. Option B. Focus primarily on achieving sales targets, with a secondary consideration for regulatory compliance only when explicitly questioned by a client or regulator. Option C. Rely on anecdotal evidence and past client experiences to describe product features, assuming current product capabilities align with previous versions. Option D. Prioritize the use of comprehensive and accurate product information in all client communications, ensuring full compliance with the specified regulatory framework, even if it requires more time and may impact immediate sales figures. The correct answer is D. Prioritize the use of comprehensive and accurate product information in all client communications, ensuring full compliance with the specified regulatory framework, even if it requires more time and may impact immediate sales figures. Explanation. This scenario presents a professional challenge for Asahi Group employees due to the inherent conflict between achieving business objectives and adhering to stringent regulatory requirements. The need to balance aggressive sales targets with the ethical obligation to provide accurate and compliant product information demands careful judgment and a robust understanding of the relevant regulatory framework. Misinterpreting or disregarding these regulations can lead to significant legal repercussions, reputational damage, and financial penalties for Asahi Group. The correct approach involves prioritizing regulatory compliance and ethical conduct over immediate sales gains. This means ensuring that all product information disseminated, particularly in marketing materials and client communications, is factually accurate, not misleading, and fully compliant with the Asahi Group Hiring Assessment Tests specified regulatory framework. This approach safeguards the company's integrity, builds trust with clients, and mitigates legal risks. It aligns with the ethical principles of honesty and transparency, which are paramount in regulated industries. An incorrect approach that focuses solely on meeting sales targets without verifying the accuracy and compliance of product information is professionally unacceptable. This failure to uphold regulatory standards can lead to mis-selling, which is a direct violation of consumer protection laws and industry-specific regulations. Another incorrect approach, which involves downplaying or omitting crucial product details to make a sale, constitutes misleading conduct. This not only breaches ethical obligations, but also exposes Asahi Group to regulatory sanctions for deceptive practices. A third incorrect approach, which relies on outdated or unverified information for client interactions, demonstrates a lack of due diligence and a disregard for the dynamic nature of regulatory requirements, leading to potential noncompliance. Professionals should employ a decision-making framework that begins with a thorough understanding of the applicable regulatory framework. When faced with a situation where sales targets might conflict with compliance, the process should involve 1. Identifying the potential regulatory risks associated with the proposed sales approach. 2. Consulting relevant internal policies and compliance officers if there is any ambiguity. 3. Prioritizing the provision of accurate and compliant information, even if it means a slower sales process or potentially losing a sale in the short term. 4. Documenting all communications and decisions to ensure accountability and provide a clear audit trail.